Welcome in our first broadcast from the Jack Burney Library, which is where Adam and Andy are located. Jack spent decades accumulating knowledge from the books on those shelves, and it was important to him to pass that information along and have that survive. This library also symbolizes our pursuit of investment excellence. Adam will review asset class returns per usual, and then also address the number one question of today, which is the likelihood of a recession and the impact that might have on stocks. Andy will use the Silicon Valley bank collapse to talk about the impact that's had on our size and style positioning and how that might influence size and style returns going forward. So, Adam?
Thanks, Lowell. And here it is, a quick snapshot of what's happened really the first 3 months of 2023. The big story this quarter, and very similar to last quarter, has been, despite what's happening in the headlines and a lot of daily volatility, we had another really strong positive quarter for the stock market across the board. So whether you're looking domestically, internationally, it was a pretty nice quarter, and actually one that was pretty solidly above the quarterly average going back 100 years. So domestic stocks, up just over 7%. International developed stocks for the second quarter in a row with really strong performance, up about 8%. And that's really one of the themes that we've seen globally in the stock market a little over the last year, is this rotation of leadership from domestic stock outperformance to international equity outperformance, and that continued this quarter. Emerging markets up about 4%, global real estate recovering very slightly from a really rough 2022, and the bond market, after what was a historically poor calendar year in 2022 for bonds, with the aggregate bond index down almost as much as the stock market, peaking down around 15% at one point and closing the year very close to that, recovered nicely through the quarter. We saw rates kind of settle down a little bit, which is a nice break from the rapid rise up we saw in 2022. So it's really, and I think Andy will touch on this in more detail when we talk about what happened under the hood of the stock market. It's really two stories and two halves to the quarter, where the first half, a really nice kickoff to the year, diminishing concerns around inflation, and then what we saw happen in March with the banking sector flipping things on their head and causing a little bit of volatility and a rotation within the stock market itself. But again, back-to-back solid quarters. If I told you, back in September, you were going to take a 6-month nap and you wake up and I gave you the headlines, you probably wouldn't be big believers that we had two solid returns in the equity markets. And that's what happened. And that's another great story, that the headlines always don't always drive what's happening in the stock market. So that was a quarter. And if we zoom out just a little bit and look at what happened in the last 1, 5, and 10 years, the last year, we're still clawing out from the declines that started in January of 2022. So we're still, if you look at where the top of the market would have been defined, we're still just about 12% off the all-time high, but with some recovery happening since this past fall. But equity markets, both domestically, internationally, still over the last year down slightly. You notice international developed has held up a little bit better. That's part of that rotation that I've been talking about, from domestic to international outperformance. And the rough, bond market still capturing what happened in most of last year. But if you look at the last 5 years, this is where I think, things start to get interesting, because going back the last 5 years, you can say we've had 3 bear markets. Just as a reminder, a bear market being defined as a peak to trough drop in stocks of 20% or more. We've had bear markets in 2018, 2020, and then in 2022. So 3 crunched into a tight window of time. two recovering in a much quicker pace than the third of last year, but still, three in a tight window. And despite that, we've had a really resilient domestic equity market, and even internationally, although low single digits, toughing through a volatile and a rough stretch for markets. And so that's another good lesson, that we're going to have these sharp intermittent periods where things can get out of sync a little bit, but resiliency through a lot of tough periods, regardless of what's happening. And then go back 10 years. If you look at the 10-year returns, for the U.S. stock market, right around or just a notch above what we would historically expect in total returns for the market over the long run. But in other asset classes, specifically overseas, you see that if you think of this as a race, the U.S. has been well ahead of overseas markets, and that's a great point of emphasis when you think about diversification. And for our wealth management clients that were diversifying across different asset classes and globally, what we've tried to emphasize is, if you think about the amount that you decide to allocate to equities, specifically now, making sure you're balanced globally, and our target is roughly around 30% of your stock mix being overseas versus about a 70% domestic weighting. So we still have a bias toward domestic companies. It's what we've done for a long time and what we're most comfortable with. But having exposure overseas, especially when you look at this return differential, a big tenet of diversification is what hasn't worked might work in the future, and vice versa. So making sure you lean into that. And now's a great time to proactively review your portfolios and those investment mix. And Andy's done webinars, and we've talked in past webinars about us helping you navigate that in terms of your asset allocation. It's still a great time to have that discussion and revisit the overall diversification of the portfolio. So those are the long-term returns. And then what's been a couple of the key economic themes behind the markets. The first, and what really dominated last year, was inflation. And I think a big point of encouragement on the inflation story is, if you look here, these are the month-to-month, annualized inflation rates going all the way back to April of last year. You notice we peaked in around June, just over 9% annualized inflation clip. That's a multi-decade high, caused a lot of headlines and volatility and concerns in the market. But the point of emphasis is we've seen significant and a pretty steady decline in the overall headline inflation rate from June of last year all the way through this most recent month. And I think the expectation is it's going to take some time to get back down to that 2% target. But some of the big worries about persistent rising inflation have subsided, and the market has responded favorably to the good momentum we have had in terms of cooling inflation. Under the hood, you think of our economy, there's a lot of different inputs and sectors of the economy, and inflation hits some parts differently than others. And two areas where inflation has been still a little stubbornly high, and it's been noted specifically by the Fed, is still in the housing market and rental market, number one, and then the service sector of the economy. So those, if you kind of add those up, that makes up for a good chunk of the economic activity in the U.S. And something that they're watching closely, and the investment community is watching closely, is when are those other pockets of the economy start to come down at a little bit of a faster rate and catch up with some of the bigger declines we've seen in areas like materials and commodities, which have dropped off significantly since the peak of last year. So that's the one point of encouragement, and something people are watching. And the other thing has been around the labor market and what's happening with employment. And so we still, even with a slight slowdown in job growth, continue to see a multi-decade historically low unemployment rate at just at around 3.5%. So we've continued to make back around on the jobs that were lost in 2020, and then some. Job growth has been fairly consistent, and so everyone is watching the unemployment rate very closely and waiting to see, especially now in light of what's happened in the banking sector and how that might trickle into the economy, what's going to happen in the labor market. And this has been a very, very resilient labor market through inflationary concerns, through, climbing out of the pandemic. We've seen this persistent strength, and there's a lot of people on watch waiting for that to break, and quite frankly, it hasn't yet. So the labor market being strong and continued decline in inflations are big, has been the kind of the wind behind the sails of the market. But really what we're shifting focus to now is what's going to happen in the second half of the year, and where should we be concerned, or what are some points of discussion, just in the economy in general. And based on what happened, and Andy's going to touch on what happened with Silicon Valley Bank and what that has done under the hood of the market and what that means going forward. The expectation now from the Fed, and they've come out and said it, it's public knowledge, the market has reacted to this, is the idea that we're anticipating a mild recession, at some point in the second half of this year or early next year. So that's what they're anticipating, and that's what the investment community is, really, put out there and is prepping for. And it's, as we always say, stocks are a discounting mechanism. They're forward-looking. So despite the fact that the market is anticipating a light recession based on what we've experienced so far this year, stocks have been resilient. And like I said before, we're still slightly off the highs that we previously saw, about 12% off the peak of where the market was. And I wanted to take a moment to talk about just recessions in general and what does that mean for stocks historically. And we've had, in the last 100 years, there's been 16 recessions. Each recession has been driven by different factors for different reasons of various orders of magnitude. And I want to just take a moment and go back and look at these 16 recessions. How long did they last? What did that mean for the stock market from top to bottom? And how long did it take for the market to ultimately recover from that sell-off? And of these 16 recessions, you'll notice here, I've got a couple columns broken out. The year the recession started, what was the ultimate market decline from top to bottom? How long did that market decline, last? So how long was that drawdown period in months? And how long was the recession itself? Because the stock market and the economy, as we've said time and time again, they don't, walk holding hands. They kind of tend to move relatively close to each other, but not in lockstep in the short run. So you'll notice a lot of these sell-offs, are very mild in nature. So we've had some really, if you look at the most extreme case, the Great Depression, starting in the late 1920s, saw a market decline of 85%, and lasted, significantly longer than the other recessions we've experienced. And other recessions are very short with very, very light market sell-offs. So right now, the market is anticipating something on the milder end of the spectrum. We've already had a 25% drawdown in the market. We recovered some of that back, but we're still 12% off the peak. But if we look at these recessions, and if I exclude the 85% decline that happened during the Great Depression, the average sell-off that happened during a recessionary period was a 15% decline in the stock market. And that lines up very closely if you go back, every year, and we know we have these little corrections along the way. The average annual sell-off in the market that happens on average every year, it's not far off that number. So recessions can be scary. The headlines can be different each and every time, making them feel unique. But the market response outside of the really major big shock-like recessions in the economy, like what happened in the 1970s, 08, and then the Great Depression, can be very can happen fast and recover fairly quickly. So that's the first piece of this. And then the second piece is, well, how long does it take us historically to recover from these recessions? And I've got this plotted out on the next slide here. Taking these 16 or so recessions, if you would have been a terrible market timer and started investing right around when these recessions were beginning, how long would it take you to make that money back and then some? and how much on average would you have been up looking forward from the bottom of that recession? So in about almost 80% of these cases, if you were a terrible market timer and started investing at the start of the recession, you would have made that, you would have been back in positive territory within 24 months with an average annualized return of almost 8%. So there's been, again, a couple cases where that wasn't how things played out, but in more cases than not, these recessions are mild in nature with historically average, market sell-offs in line with what we expect during a normal correction, and markets recovering in short order. And that's the difficulty of investing in general is handling the headlines while all this is happening, each time feeling unique because different factors can often drive recessions, and then staying disciplined throughout. So we're going to continue, even in spite of the fact that people are anticipating a light recession this year, controlling what we can control, having those longer term discussions and positioning portfolios to take advantage of whatever the market gives us along the way. So that's some basic context on recessions and where the market is. And when we go to Q&A, we'll dive into some of that in more detail at the end. But now I'll pass it to Andy to talk specifically about the strategy and what we've been doing.
Yeah, sure. And real quick, before I do that, I just want to take a moment to welcome you back. It's been a couple webinars since we've had you on, and Ben did a great job filling in your place. But for us to be able to do this together, debuting the Jack Burney Library, I think is really cool. So welcome back, Adam.
Yep, thanks, Danny.
Yeah, so as Lowell mentioned at the top, I wanted to take a moment to use the Silicon Valley Bank crisis as a launching point to get into the broader stock market trends. But I think we all experienced 2022 was a bear market. There were peaks, there were valleys. The most recent valley occurred on October 12th, so really right at the beginning of the fourth quarter. And really ever since then, the market was pretty boring. It's kind of hard to think about a bear market and a boring stock market, but the economic news tended to be pretty good. The inflation data was coming down. Unemployment rates, as we continue to see in Adam's slides, were low. And wages were, strong, but not too strong to negatively impact inflation. And so the stock market grinded higher. And in fact, from that October 12th low, it was up about 15% in early March. In fact, Google Trends peaked in February for the term soft landing, as it seemed more likely that the Fed would actually pull off the mythical soft landing and not push us into a recession here. But while that was all happening, it also felt like there was some storm cloud, like there was something we weren't seeing. There was another shoe to drop. And even though stocks were making ground and economic data was good, it felt like there was another shoe to drop there somewhere. And then suddenly, March 8th, 9th, 10th, we found that with Silicon Valley Bank failing. And if you're anything like me, I couldn't rip myself away from that storyline all weekend long. Obviously, I didn't have any money at Silicon Valley Bank, but it's not every day that a bank fails, and not every day that a respected 16th largest bank in the country fails. So, if you were a client, a customer of Silicon Valley Bank, you had all your money. You had no idea if you had your money, right? You had a weekend basically where it was you were unsure. Is this funds that I still have? Does it exist still, or am I going to have to close up shop? A lot of these. A lot of people who had money in Silicon Valley Bank were actually companies, and their futures were unclear. So there was a lot of chaos. And we've had a little bit of time since then, though, to kind of take a step back and evaluate what's going on. And sure, over that weekend, it was easy to panic. Even if you didn't have your money at Silicon Valley Bank, it's easy to remember, this is ghosts of 2008 all over again. Is this just the first thing in a domino? Is there a weakness in the general banking sector? And I think what we've discovered is Silicon Valley Bank was a really unique situation. And there were a couple key things at play. First of all, the vast, vast majority of assets at Silicon Valley Bank were not FDIC insured, either because they were, company assets, or they were well in excess of the $250,000 coverage. And, so that alone was somewhat unique to Silicon Valley Bank, but it also had a very concentrated and close-knit customer base. Basically, it's in the name. This was the bank for people who were in Silicon Valley Bank, who were in Silicon Valley, venture capital funds, that whole exciting, growth segment of the market. And those people are really, really tight with each other. So it just so happened that high profile venture capitalists were advising their founders and their companies to try to pull their money out. And so, you know, and then the reason they were being advised to do that is because there was no FDIC insurance. So all of a sudden, everyone in that very, very close-knit community was trying to pull their money out. And, you know, there's all sorts of podcasts or newsletters you can read that kind of get at the chaos that infused. And, you know, a big reason why, you know, that this was such an issue for Silicon Valley Bank is they had a huge influx of assets come in the post-COVID period when interest rates were once again very low. There's a lot of venture money going into these companies, more money than they could spend. So they were just storing it up at the bank. But then the macro conditions came in with the Fed suddenly raising rates. And that really hurt Silicon Valley Bank twice as much as probably the typical bank. I mean, for one, there were unrealized losses in the Fed, in the bank's books when it came to their bond funds, because the bank had people had too much cash. They didn't have anything to invest it in. The bank couldn't loan it all out. And so they were buying intermediate term bonds to try to get a little bit more yield and eke out some more returns. And so they were technically likely insolvent, you know, while this bank run was happening. But the other piece of this is that because that venture money was drying up. So you have the unrealized losses as one part, but that venture money was drying up for these portfolio companies. So rather than being able to put money into the bank, all of a sudden they were withdrawing money out of the bank just to fund their businesses, make payroll, do all that stuff. So that money was also coming out, and it forced Silicon Valley Bank to sell those assets at a loss. And so it was this combination of events made Silicon Valley Bank uniquely prone to a bank run. And it's part of the reason why you haven't seen, I mean, while there are other banks that have some weakness, you haven't seen some system-wide contagion happening. And in large part, that was because, you know, while there was a weekend of extreme uncertainty, the FDIC, the Fed, the Treasury, they all stepped in quickly to stabilize the sector. And so they did a couple key things. One, they took over the bank. They used the systemic risk exception to basically insure all assets. And that essentially stopped, you know, bank runs from occurring at other banks. So it certainly is the case that other banks also have unrealized losses in their long-term investment book. But, you know, that's okay as long as they're not forced to sell them like Silicon Valley Bank was. So, you know, right now, today, we're still seeing some banks in the news. I think First Republic is probably the big one. There's maybe one or two others where it's sort of unclear what their future is. But at least for now, the FDIC is letting them keep going. Some of the bigger banks are propping up with some funding, and there's, you know, the Treasury is also has a revolving, you know, line of credit basically that these banks can tap into as well. So there's some reason to think that you know, things might be okay for these banks, but still remains to be seen. The larger banks, though, have had a chance to report earnings over the last week or two, and it's largely been good news. JP Morgan, Citi, Wells Fargo. You're not seeing the same type of issues at these large banks that you're seeing at some of these others like First Republic. So basically, it feels like things have sort of calmed down, and we see that with the way that the stock market reacted and the way that volatility reacted. So the surprising thing, at least to me, you know, I was expecting, you know, this is the big event that no one sees coming. It's out of left field. This is, you know, maybe we're going to feel those March lows or those October lows again. And it turns out the S&P 500 basically yawned at it. Like, sure, the stock market was down a little bit for a short period of time, but you know, on this chart, the blue line here is the volatility index VIX. Basically, it's the market's fear gauge. And while it did spike, you really didn't see the negative reaction out of stocks. And, you know, for the middle of the month, volatility remained high. There was a slight drawdown, but the S&P 500 actually ended March above where it started, despite, you know, this banking crisis. And even the volatility index was back. And today, it's actually back below where it started the month of March, indicating that there is a lot less concern about this in the broader stock market. But it did create something of a bit of a counter trend. So, you know, if you're following what we were doing with your investment strategy throughout last year, we've been leaning into value. You know, one of the other things we've been doing is leaning into small cap stocks as well. And, you know, this was sort of a counter trend month, and that's completely to be expected when you're in the midst of a bigger trend. But while the S&P 500 was positive by 3.8% in March, if you just took the highest beta stocks within the S&P 500, that is the stocks that are most, you know, exposed to stock returns, they'll go up hugely when the stock market's up and go down hugely when the stock market's down. those actually were negative for the month of March. So even though the broad S&P 500 was positive, the highest beta stocks were negative. And if you go down all the way to small cap stocks as well, they were almost down 5% for the month. So, we would definitely call this a risk off month, as the high beta stocks were down, small caps were down, and it was a little bit counter to our positioning. So I think it's a fair question to ask. It's a bit of a tough month, relatively speaking, for investment strategies. What does that do to the overall trend of the market? And we track this, every month. So this data here is updated through the end of March. And what we can see with regards to size, this was a pretty large large cap, move. So the larger trend had been that there's maybe some small cap momentum, but this was one big month that was down, pointing towards large caps. And I also want to point out that it was just 1 month, and so 1 month doesn't make a trend. And in fact, when we look at the longer term trend, and this is our preferred time frame for trying to predict what market phase is going to be in favor moving forward. So we're looking back at the rolling 3-year differentials between large caps and small caps. We see that the line is pointing up. And what that means is it's pointing up towards the very beginning of a small cap phase. So, even though we had a big move down in that month, it didn't do anything to change the longer term momentum. We'll need to see more evidence of a shift towards large caps, to really come off our small cap tilt right now. But, so basically what we're looking at here is it's likely this is the very beginning of a small cap phase, despite what happened in March. And we think that small cap positioning is still going to pay off later in the year. It was actually a very similar story for value. And in fact, probably shouldn't be surprising that, banks, financials, that's a value dominated sector, that subset of the sector, the regional banks, while we may not have had too much exposure to it, it did kind of pull down the whole sector a little bit as well. So yeah, banks are down. That means value is probably going to lag a little bit relative to growth. And we did see that a little bit in February and definitely in March, although it's notable that it wasn't as bad as the small cap momentum. And so with value, it's a little bit of a different trend. We've actually been pretty substantially in a pro value environment for longer than a year now. So going back to January of 2022, value has outperformed growth most months over that time frame, and it's been actually a relatively long time for value outperformance. So our read on this is, yeah, we have 1 or 2 months that are against that trend. It's still not enough evidence for us to come off the value tilt. Because we still are in a pro value phase when you look at the longer term cycling data. That being said, it's probably worth examining very closely, because we are, maybe somewhere about halfway, 75% of the way through a typical length value phase. I'll say that there is some fundamental data and reason to still believe in value. For one, valuations for value stocks versus growth stocks still look quite attractive within the value sphere, even with the 2022's pro value phase. So we're not overreacting yet. But I think the big question that we have, that I think you probably have as well, is, was this regional banking crisis just a flash in the pan and just a simple counter trend against the broader trend of the market? Or is it a turning point for the size and style cycling? And so while we still believe that small and value is the place to be, and that's gonna add value throughout the rest of the year, the honest answer is we don't know, and it's something that we're watching very closely. So there's some data to suggest that, hey, volatility has declined. So far in April, we haven't seen the same dispersions we were seeing in March. So maybe this was just a one-off event, but it still could be something bigger. We simply need more months of data to be able to make that call. So I just wanted to point out that it's something that we are watching very closely as we go into the second quarter here in 2023, and will be a storyline probably you hear us talk about moving forward. All right, and so it looks like we are right on time. There was a great response this quarter with questions. So we did ask for them at registration, and you guys delivered. So we think that some of the questions we probably have answered during the presentation part of this. So we'll skip that for the Q&A. And there's so many questions, I don't even think we can get to all of them anyways. But if you feel like we didn't adequately answer your question, or if we misunderstood your question, please feel free to reach out to your advisor and have a conversation about that. So I'm going to kick us off with the first question. I think we're going to start sort of with some macro things and then go more specific for the organization of questions. So Lowell, I'm going to ask you to answer this first one, and give me a second here to read it to make sure I get the wording right. Is there a recognizable period where an unsustainable economy becomes not investable? Oh, hey, Lowell, you think you were fine. You just muted yourself though.
Okay, here we go. I'm back
There you
on.
are.
Very good question. Point with exactly what the intent of that question was a couple times. I'm going to hope that I get it right. But before I get into that, Andy, there's one more question in our Q&A section that maybe was already addressed. But take a look at that if you would, to consider that as well in our panel here. So, so keep in mind, as Adam previously mentioned, the stock market is a basically it's an expression of future expectations in the economy and in the stocks in general. So if you have an unsustainable economy and you have a free market pricing system, then that unsustainable economy can't, well, it shouldn't last, right? There's going to be financial pressures. The stocks of companies that are involved in that unsustainable part of the economy are going to get crushed. There's going to be enormous pressure for them to have to adapt to whatever the better environment is. And, you know, you see lots of examples of this through time. There are economies that don't make that adaptation. Those tend to be ones that don't have enough free market influence in them. So there is a risk of that in many parts of the world, but I don't see that as a material risk when you're investing, especially in the U.S. I think the U.S. is one of the the stellar examples of the utilization of free market, even though we step in every once in a while with the Silicon Valley crisis. But basically, there's a process to deal with companies that can't perform in relation to the rest of the company. So that should not be something that that occurs with us.
Okay, great. I think that answers that question pretty well, but you know, if it didn't, please feel free to follow up. We'll keep it macro here real quick before we keep it moving. And Adam, maybe I'll ask you to answer this one. So questions about oil prices and how that might affect the market and our returns. Any thoughts on that?
Yeah, so just to address oil directly, I mean, oil prices are incredibly volatile. If you're tracking oil prices in the short run, you see very quick moves up, down, sideways. It's, a volatile commodity, and it's, there's top heavy control of the oil market, so there's geopolitical factors that are a big part of oil price movements as well. So in the very short run, the market can react to oil price movements. But, oil prices are one of a very, very long list of inputs into the economy and inputs into what company, stock prices will react to. So over longer periods of time, oil in and of itself is not gonna shake the market on its own, right? And there's been actually, because of the attention oil gets, there's been studies done on the correlation between, stock market returns and oil prices. A lot of those have been debunked to say that there's really no meaningful relationship between the two. The reason being is, there's offsetting factors against oil in the economy. There's specific companies that might be exposed to oil much more heavily than others, and they're, obviously that's part of the portfolio diversification question and part of the analysis of specific investments. But all in all, while it makes for a headline and it's the one thing a lot of people can point to in booms and busts in the economy, it's not going to swing the market in and on itself.
Yeah, you can expect it to be volatile and you can expect it to be unpredictable. And
Yeah,
I think it's almost like that uncertainty is predicted by the market, right?
yeah, yep.
Yeah. Okay. So I think that's a good jumping off point for the next set of questions. And we had we had like a whole group of questions that were talking about different things, but really asking the same question. And essentially it's, where do we expect the stock market to go from here? And the words about the bubble and is there a bubble? Are there Fed expectations in terms of what they're going to do from the rate hikes perspective? And just are we going to see some sort of a correction, maybe due to a recession or something? And so I just wanted to, I think the three of us may have thoughts on this, but I wanted to jump in real quick before you guys have a chance to answer and just say, I think that the market expectation, as you mentioned earlier, Adam, is that a mild recession is a pretty likely possibility, and maybe it even is the expectation moving forward. But to your point about, we've already seen the stock market decline, as part of this. And, it's not necessarily a given that, we get to a recession and the stock market falls, right? If the average decline, during a recession is 15%, well, we more than eclipsed that already with the stock market move. And it is a forward-looking discounting machine. So, that would be priced in. I think the really interesting thing though is there's this huge, right now, after the latest inflation report in the Silicon Valley Bank crisis, there's this huge divergence in what the Fed says it thinks it's going to do in terms of where interest rates will be at the end of the year versus where the market thinks they'll be at the end of the year. It's just for whatever the Fed's like famed dot plot means, they're expecting maybe one more quarter point increase. They were going to do the last rate hike last month, but they basically cut it in half and are spreading out over 2 months instead. And then they expect to kind of hold steady from that point forward. The market is expecting them to actually start cutting rates later this year and it be at a point that's materially lower than it is now. So it'll be interesting to see how that shakes out. Basically, to me, that's good evidence of the market saying, hey, you're going to tilt us into recession, Fed, and you're going to have to start cutting rates, sooner than you think you will. And, the Federal Reserve isn't baking that expectation in, so it's kind of difficult to square what's going on. But I think it's fair to say there's still some uncertainty there as far as that goes. So it's predicting what the market's going to do moving forward. It's probably tricky to say with any degree of certainty where we're going to be because we just don't have the economic data in yet to see. The Fed took rates from 0 to 4 or 5% in a very quick period of time. We know it broke Silicon Valley Bank. We don't really know if it's going to break anything else.
Yeah, think about all the people you have that are paid a lot of money to sit around a table with PhDs, and they spend decades of their career studying every small movement in the economy and doing historical analysis. And even they would tell you at the end of the day, there's no real rock solid, reliable way to predict movements in inflation and also in the economy in the short run. So to continue to hammer home on the point that recessions are a very natural part of the economic cycle. You can argue that they're necessary in order to achieve long-term healthy economic growth. They happen on average every 5 years. So when we say the R word, it shouldn't be a surprise to anybody. But we tend to naturally benchmark, what's going to happen next to what has happened previously. And 2020 gets written off because of how quickly it happened. It was a manufactured recession. There were unique circumstances around it. But going back to 2008 in terms of a once in a century, really not a recession, but an actual economic crisis that was unique in its own way. It's a natural pivot point to say, well, the next recession is going to look a lot like that. And, there are recessions of all shapes and sizes. Like I said, they all translate to different levels of economic slowdown and declines and inflation rates and unemployment. And so hearing that and processing the fact that we've already had a 25% sell-off and kind of being one of the people that's shaking their head now saying, well, we know something the market doesn't, what's happening? They're saying there's going to be a recession. Why isn't the market falling 50%? And that's because of the anchoring back to what's happened and not acknowledging and accepting that, the market is a forward-looking discounting mechanism that we need to be afraid of when we think of things like that.
Yeah, absolutely.
So I guess I'll add a couple of thoughts as well. The market decline, a sharp market decline is always going to be triggered by something that is unknown in the moment, right? It's going to be some unexpected event that blindsides everybody that has a big price response. So all of the things that we're talking about and thinking about, if there is a big market correction ahead, is not going to be related to any of those things. It's going to be something unexpected and different. And there's always risks out there that, obvious risks today. Two big ones might be an impasse with the budget and another risk of a potential default on our federal debt. China, Taiwan could blow up. I mean, there's always going to be risks. I'd say it's very important to think about the fact that the next big correction is not an if, but a when phenomenon, right? There will always be the next big correction. That's just part of the process of investing in stocks. You need to make sure that your portfolio is positioned accordingly. But whatever that crisis is, we're going to recover from it, and the market will go on to higher ground. So if what we're in the process of right now is sort of yesterday's problem, the prospects for the market are great. Could there be a new problem that tanks everything? Absolutely. Eventually, it will. It will. But you can't know that today, and you really can't invest in fear of that, because that risk is never not going to be present.
Yeah, good point. Good point there. This might be, Lowell, you mentioned that someone threw in a question about the in the Q&A function here. Might be a good spot to kind of work that one in. So basically the question was about the Silicon Valley Bank and Elon Musk believing that it might be the start of worse things to come, US global banking. I think that as far as that goes, mentioned in the slides, Silicon Valley Bank was a very unique situation in that they were prone to a bank run. And yes, it's the case that other banks likely have unrealized losses on their balance sheets as well. But the fact of the matter is that's only going to be an issue if there is a run on the bank. And we simply haven't seen that happening. And so I think, while I respect Elon Musk, I drive a Tesla myself. I think that probably is an overreaction to what was, one uniquely positioned bank in a really unique time, being prone to a bank run. And it's probably not this broader, we haven't seen broader contagion yet to that point. And so, that seems like it would be an unlikely scenario.
So
In
Andy,
a banking world. So go ahead, Lowell.
go ahead, Adam. I'd like to comment as well.
Yeah, I was going to say, just the banking world in general has gone through substantial overhaul since 2008, right? Like we kind of learned lessons about risk in the banking sector and how that can spill into the economy. And I think that's why in March you saw a big sell-off in the smaller regional banks that aren't covered by some of the reform and the risk mitigation that was put in place post great financial crisis. And the bigger banks, like Andy said, they're coming out. They're heavily scrutinized and analyzed by Wall Street. You didn't really see much significant movement or reaction from those banks, across the board.
So I interpreted that question a little bit different. I don't think it possibly anyway. The question wasn't really about SVB, but more generally about it being the beginning of something somewhat related to it. So, and there was a question that I don't know if we're going to directly answer, but there was a question specifically about bubbles that I wanted to also talk about. So bubbles are a normal market phenomenon. They've been going on for as long as investing has occurred. They follow exactly the same pattern. This was I remember giving presentations before .com in the late 90s, talking about here's the conditions and these are the present conditions. And and at the top of the list of a bubble is a transformative technology. So I think, the open AI, all of the artificial intelligence disruptions that are going to occur is maybe really what he's talking about. And I would say two things about that. One, these transformative technologies, when it's all said and done, are enormously beneficial economically. Think about railroads and airplanes and all the different the internet, all the different things that have occurred. They're beneficial in the end, but they almost always spawn a bubble. So I think that there's going to be another sort of high risk area from an investment standpoint ahead, and we just need to think about it. Like be cognizant of the fact that this is potentially trouble, but it'll be trouble for the investors that get sucked in and are sort of blinded by the glimmering opportunities there versus the ones that are anticipating and investing accordingly.
Yeah. So hopefully with those three answers, we covered the intent of the question. We just have like a couple more left before we'll let everyone go here. There was a question that came in about our thoughts on publicly traded real estate investment trusts, so REITs. And their positioning as an asset class in the now in the near future. I'll jump in on this one. I think that as far as REITs go, I'll start by saying it is it's a sector within the stock market. Real estate's there just the same way that, industrials are there, information technology. So I think it does make sense to have some allocation. I think that there is some concern about REITs, especially when you look at, commercial real estate, office buildings, things like that, where, there is a new normal where we're all in the office right now, but, office buildings are sitting vacant in a lot of our biggest cities, still to this day. But, that's not the only opportunity set within REITs. There's also things like data center REITs and public storage REITs and all sorts of different types. So I think that it does make sense to still allocate to REITs as part of your overall asset allocation. It may or may not make sense to do more than just what the market neutral weighting is, which is somewhere around 5%. And I also want to touch on there can be some attractive private REITs out there as well that might be worth exploring. I would say before you touch any private REIT, talk to your advisor to see if that makes sense, because we may have some solutions as far as that goes, and we can talk through the pros and the cons. So I want to touch on that with REITs. And then Adam, maybe I'll get you to answer this next one. Basically, it's based on the current market. It's asking about should we make any tactical shifts within, say international versus US domestic, or maybe in the fixed income space. So, since you're heavily involved in our asset allocation models and the wealth management side of our business, I'll have you address that one.
Yeah, I mean, a short answer is yes. And these are things you want to, I would say portfolio changes should be evaluated consistently through time. So yeah, what you don't want to do as an investor in all points is just simply be reactive to what's happening. You want to, be looking at a specific mix of investments and saying, okay, based on forward-looking assumptions on risk and return, what might make sense in terms of the mix and the diversification. And there's two main areas that have been a point of emphasis. The first being, and I talked about this a little bit, the mix of within the equity portion of your portfolio, how are you balanced between domestic companies and overseas? And this has been a place where a lot of investors have been heavily overweight US and heavily underweight everywhere else. And the last almost 15 years, that's worked beautifully. We've had a historic run of US outperformance to the rest of the world. These things are cyclical, right? Just like we talk about size and style, US versus international returns tend to flip-flop back and forth with some regularity over time. This most recent cycle was painfully long for people with international diversification because of how well the US did to the rest of the world. But from, excuse me, really from a valuation standpoint, you can make a case that you want to have some meaningful exposure overseas as part of your overall investment allocation. And for us, that target is loosely somewhere around 30 to 35%. And so that's point A. Point B is on the fixed income side. Bonds historically have played the role of the balancer in the portfolio. So typically when the stock market has gone wonky and really volatile, bonds are a stabilizer. Last year we did not see that. We saw stock and bonds fall by almost the same amount. There was almost no diversification benefit of holding your standard bond portfolio with some equity. But on our end, something that we had shifted and tilted, especially as the rate environment was changing, is being a little more heavily weighted in shorter term versus intermediate and longer term bonds. So that's one of the big changes we made. When you start to see US government bonds 6 months and a year or two out paying 5% in interest, it's hard to run away from that in the context of the bond mix. So that's something that at least in the interim that we've looked at, and we're really excited to do. Finally, the last 10 years were, as you said, Andy, a zero interest rate environment. The idea of finally getting income from your bonds is a little bit exciting, even though inflation is running hot and above that. As inflation comes down, you should start to see some real benefits finally for having the appropriate mix of bonds if it makes sense for you.
Yeah, it's been suddenly been a very different market environment, versus where we were. It felt like, it was basically a decade of very low interest rates where you're basically getting nothing out of your fixed income. And so to be able to all of a sudden get respectable yield just turns that whole storyline on its head. And you see it in other areas, internationals, especially like developed markets doing well. relative to the US. That's like a relatively new, switch as well, because forever it's been like, we know international stocks are undervalued. They just keep underperforming those.
Yep.
We're finally seeing some life there, which is good. And
So,
then
Andy, let me touch on that real quick, if I
Yeah.
could, please. So, part of the process, and Adam is the chair of our investment management or wealth management committee, the asset allocation decision making group within the company. One of the key pieces of information that we examine is fundamental variations. And if you take U.S. and developed international as an example, there had been a long growing divide in terms of relative pricing of those two asset classes. And if you go back a year, 2, 3 years ago, it got to a point where there was a significant discount for European, or developed international relative to U.S. Equities. And that, that's part of the driver of our decision making. But you have to be willing to play the contrarian, because if that's the cause of the valuation difference, a 10, 15-year persistent performance differential, it's going to be a very unpopular asset class when you go into it. Managed futures could be another example of that same sort of phenomenon, a year prior to that. So there's good reasons. If there are good long-term fundamental reasons to own something, it's really essential to be patient with those asset classes, especially when they lag.
Yeah, great point. Great point. All right, so we've gone way longer than we typically go on these. So, of course, your first one back in a while. We had to make it a marathon for you, Adam. But we only have one question left. So there's a question that came in about the Bernie ETF, how it's doing, its place in client accounts, and so I'll address that one head on. For one, we basically launched the ETF for two reasons. One, we wanted to be able to run our size and style responsive U.S. equity strategy that we use for the vast majority of our clients in a more tax efficient way. And our experience so far with running the ETF is we've seen that play out firsthand. We're able to, trade it the same frequency that we were trading, before with our separately managed account strategies. But we've been able to so far mitigate tax as well with the way the ETFs work. So that's gone very well. And then the other area where we've used it is just in our smaller accounts. So if let's say that you had a small, you open a $6,000 IRA or something, we would use ETFs like size and style corner ETFs to invest that. So you still get the size and style cycling that we want to do, but you just don't get the added stock selection piece on top of that. So we're in the process now of converting that version of SSR into just the BRNY. And, we think that's going to be a major positive, because now, even if you have a smaller account with us, you still get the full, size and style cycling and stock selection piece of our investment strategy. So just, high level, we're using it in taxable accounts, we're using it in smaller accounts, and it's, we've been able to execute with inside the ETF the same way we do just, our standard account. So it's been a good experience so far. All right. Well, I wanted to thank everyone again for joining us today for the webinar. We had a great response, and we appreciate you all checking in. We will be recording this and posting it to our website at some point later this week. So, if you think anyone in your life missed it, could have benefited from this presentation, please feel free to forward it out to them. But for Lowell, Adam, myself, we look forward to talking to you again soon.